good morning, everyone, and welcome to our March EITF meeting. Today, before we get going on our different topics, I do want to start because we have a few new faces here in the room today. So I want to start with a few introductions and special welcomes. First, want to thank Todd Castagno for agreeing to join the EITF. So our new member, who's a managing director at Morgan Stanley. He was appointed last month, and we're very excited for him to be able to join the discussions today. We also do have two new observers who are observing the meeting today. We have Sherry York, who recently joined the SEC's Office of the Chief Accountant as the Deputy Chief Accountant in charge of accounting. And David Finkelstein is our new observer from the Private Company Council as well. And we are also joined at the table by Edward Garcia, who is going to be transitioning as our EITF coordinator when Alana transitions out of her fellowship. So we do want to thank Edward and have him here as an observer today to learn the process and get to know everyone. So in addition to all of our new members, we have Rich Jones here today, as well as FASB staff, as well as our FINRAC observer on the line as well today. So we have a great group of people here to start the discussion. Today, we're going to start with our mortgage servicing rights recapture issue. For those of you who are watching the meeting online, the discussion materials are available on the website and do include the background on the issue and the questions that are going to be discussed here by the EITF today. Now, before I hand it over to Dan Palamaki, who thankfully did make it in here today through trials and tribulations. So thank you so much for the commitment, Dan. But if you are participating virtually, we do have people who are on. Please use your raise your hand function if you're participating virtually, if you have a question or a comment. If you're here in the room, feel free to physically raise your hand. You can give us the touchdown signal if it's something that you want to respond to immediately based on someone else's previous comment, and we'll come back to you in a timely manner. So with that, I will turn it over to Dan.
Great. Thanks, Hillary. I wish someone gave me a call 4 hours ago and said, avoid the Tappan Zee. But yeah. But no, great to be here. And I'll kick off the issue that we have on the agenda this morning. The question that we're really looking to address here today is whether recapture rights should be considered in the measurement of servicing rights or mortgage servicing rights. Mortgage servicing rights, MSRs. Currently, there is diversity in practice on this matter. For high-level background purposes, when we talk about servicing, that really refers to operational activities that are required to manage financial assets. So it can be collection of payments, monitoring past due status. There's a variety of things that are involved there. A mortgage servicing right is a contractual right to service the underlying mortgage loan itself, and the servicer earns servicing fees as well as other ancillary types of income. Servicing is inherent in all financial assets. It becomes a distinct asset only when it's separated from the underlying financial asset through a sale transaction, securitization transaction. And typically when that happens, we talk about servicing rights being retained. You can also purchase servicing rights or acquire them in the marketplace. Recapture, which is the focus of our issue today, occurs when a loan underlying a mortgage servicing right is prepaid and the loan is refinanced with the servicer and thus retained. When this happens, servicing fees are lost from the prepaid loan, but they're recaptured through the economics of the new loan under the new lending arrangement. The marketplace ascribes value to recapture. For example, when interest rates fall, the servicer is uniquely positioned to understand the point in time when to pursue and solicit a refinancing transaction with the underlying borrower, given the access, the knowledge of the terms of that loan. Currently, there's diversity in practice related to how entities consider the value attributable to recapture in the measurement of a mortgage servicing right. We find for retained mortgage servicing rights, the practice is mixed. Some entities will incorporate recapture rights in the valuation, others will not. For mortgage servicing rights that are acquired in the marketplace, generally we find recapture rights are included from a measurement perspective. We also see diversity in practice for those entities that do incorporate recapture rights in the measurement of an MSR. How do they do that? Some entities explicitly estimate cash flows, put those into their model to come up with fair value. Other entities will make some adjustments to underlying key inputs to the valuation of the MSR. Could be the discount rate or prepayment speeds. This diversity in practice can result in lack of transparency, inconsistency, and uncertainty in financial reporting. The accounting guidance for MSRs is in ASC 860, which requires MSRs initially be recorded at fair value. Subsequent accounting can either be amortized cost or fair value. 860 has very limited guidance on the measurement of fair value for MSRs, but practice typically is consistent with ASC 820, the fair value measurement standard. So we look at market-based inputs, not entity-specific inputs. MSRs are very complex assets to fair value. A number of the inputs generally are not observable, so we'll find that MSRs are level 3 from a fair value hierarchy perspective. For banking organizations, they also carry a very heavy capital impact, and so their risk weighting is 250%. They get to a significant level of like 25% of capital or common equity tier 1, it'll be dollar for dollar or 1,250%. So MSRs are expensive for banks from a capital perspective to have on the balance sheet. Subsequent measurement guidance in 860 for those entities that are amortizing MSRs precludes considering recapture when determining how to amortize those MSRs. FASB staff has done a great job performing research, looking at prior standard setting, interpretations, regulatory guidance, public company filings, and very significant outreach to about 20 different stakeholders, including practitioners, preparers, valuation specialists, and an investor. And I think the issue summary does a great job capturing results of that work. With that brief introduction, I'd like to now turn it over to Michael, who will summarize the issues that we're looking to address today.
Thanks, Dan. The issue summary, which as Hillary mentioned is located on the EITF projects section of the FASB website, highlights several issues for the EITF's consideration, some of which may or may not be applicable depending on the EITF support for other alternatives. More specifically, as noted in the materials, the EITF's decision for issue A will affect whether issue D, E, and or F are discussed, while issues B and C apply regardless of the EITF's decision for issue A. Each of these issues are described in the issue summary, and therefore we will not be teeing them up in detail. However, we did want to briefly summarize the alternatives being considered to help those watching the meeting follow along. First, issue A. This issue was frequently identified as a pivotal decision point in outreach and considers whether the MSR and recapture is 1 unit of account or 2. There are 3 alternatives for the EITF to consider. Alternative A1 would specify that the MSR and recapture are a single unit of account. Alternative A2 would specify that the MSR and recapture are separate units of account that must be accounted for separately. And alternative A3 would specify that the MSR and recapture are separate units of account that are combined into a single asset if recapture qualifies for recognition as an asset under GAAP. This would mean that recapture would be included in the measurement of an acquired MSR, but excluded in the measurement of a retained MSR. The recommendation for issue A is alternative A1, 1 unit of account. The next issue, issue B, asks whether recapture should be defined, and if so, how. Under alternative B1, recapture would be defined using one or more of the items listed in paragraph 67. Under alternative B2, which is the recommendation, recapture would not be defined, and an entity would value the unit of account specified in issue A. The next issue for consideration is issue C on scope. Under this issue, the EITF will consider whether any recommended solution should apply to only residential MSRs or to all servicing assets within subtopic 86050. The recommendation for issue C is alternative C1, residential MSRs only. As I mentioned earlier, issues A, B, and C will be considered regardless of the EITF's decision in other areas. The next two issues, issue D and E, apply only if the EITF support an approach that combines the MSR and recapture into a single unit of account or asset, which would be alternatives A1 or A3. Under issue D, the EITF will consider whether changes would be addressed, would also be needed to the current amortization guidance in subtopic 86050. And under issue E, the EITF will consider whether new disclosures would be required. The recommendations for issue D and E are D1, do not amend current amortization guidance, and E1, do not require new disclosures respectively. As noted in the materials, if the EITF instead supports alternative A2, which is 2 units of account that should be accounted for separately, the EITF will be asked to provide feedback on issue F that analyzes whether recapture meets the criteria to be recognized as an intangible asset. Finally, we will cover the standard EITF matters, including entity scope, whether the application would be optional or required, and ask the EITF for feedback on transition and early adoption. Here, the recommendations are that the recommended approach should apply to all entities and should be required versus optional. And with that, I'll hand it over for discussion.
Perfect. Thank you, Dan. Thank you, Michael, for that tee-up of the issue and the questions that we have to discuss today. I thought it would make sense to first open up the floor to EITF members. As we mentioned, there are a number of issues that kind of rely upon probably the first decision of the unit of account. So maybe for purposes of opening it up, if we have folks who have specific views, comments, perspectives with regards to issue A in question 1, that would be great. I'll open it up to EITF. Brandon.
Actually, Dan, can I ask like a factual question about what you said about banks and the capital requirements? So is it fair that the capital is on whatever's on the balance sheet, i.e. the fair value in any period, and that if we did A1, for example, and directionally banks would increase the value of MSRs, does that mean that their capital requirement would therefore also increase?
Yeah, good question, Brandon. I think that's my understanding. So it's the recognized amount of the MSR that's on balance sheet, then that formulaically gets to 250%. And if it's, greater than 25% of CET1, it'd be dollar for dollar. I'm not aware, I have not heard from an industry standpoint that there's sensitivity on, if, let's make it up, MSRs increase 5% because of this. I'm not aware of any stress from an industry standpoint on that. There are, with the Basel capital reproposal that's expected any time now, there has been some indication that potentially for residential mortgages, capital requirements could be less than what we have today. Now that's focused on loans, but there's also commentary out there that the RWA amount relative to MSRs could be capped at 250%. So there's, but again, I don't think it's really that concerning on how we adjust fair value from a capital perspective, if that helps.
Thank you, Dan. Other comments? Angie?
Sorry. Maybe just a question for Michael and the staff relative to the outreach to users and investors. I think I read in the summary that investors want a consistent model with acquired and retained. And I wanted to push on that a little bit relative to whether the question was asked, do they want consistency, or would it be okay to have consistency within banks and consistency within non-banks? Because my sense would be that maybe that would be okay to have inconsistency as long as it was ring-fenced into banks and non-banks. So just wanted to get your thoughts on that.
I think the way the master phrase it, you just wanted to be able to have comparability across all the companies that we're following.
So originators and not originators.
Mm-hmm.
Okay.
Sorry, and maybe just to add one thing, some banks also acquire MSRs as well as originate and retain, and so they would want consistency within that entity as well, if it did both.
Brandon?
Well, to get to the, I guess, reactions on the views, and that was what Ashley just said was very helpful to me, because although banks could be primarily originators, they could acquire other banks, not just straight MSR acquisitions, but acquire other banks, and in the acquisition have to account for MSRs. So that's why I sort of lean towards alternative A1, which is the recommendation in the paper. I think we could get into a lot of conceptual discussions around unit of account and whether this is truly a separate intangible that's acquired as or recognized inside another intangible. But to me, MSRs are the only executory contract that you can elect fair value on a go-forward basis. And I think there's some compelling things in this paper around, the contractual provisions, i.e. the right. And I do think the value does relate to the contractual right, but I think we can still square that with allowing recapture, because the contractual provisions will allow the servicer to recapture. And that has more value than a contract that prohibits you from realizing the value of recapture. So I think we can square that conceptually and still have a single unit of account. I do think there's an interesting question around the further customer intangible, like the customer right. I think the paper discusses that currently companies don't really, when they think about bidding for MSRs, put a lot of value in these other potential rights. But if we don't define recapture and we allow this, I feel like we're saying that it's an all-in fair value. So if in the future people start putting a lot of value on those other intangibles, they're going to inherently be part of the fair value. And it is what you actually pay to acquire an MSR. So I do think there's an inconsistency in question 2 of SAB 109 that will be there if we don't correct question 2 of SAB 109. Maybe today that doesn't have a huge fair value differential, but I think looking forward, it's possible that it could. And I think we should think about, and maybe that's a question for the SEC that we can't solve here at the FASB, but I do think there would be an inconsistency if we go to A1 without a definition, is it's just going to be an all-in fair value.
Thank you, Brandon. Tom?
So in reading the paper and reflecting on the issue, I continue to believe that there's definitely a customer relationship intangible that is, attached in part of the mortgage servicing right. And so I'm not opposed to including that in the fair value overall as sort of a bundled, fair value unit of account. But I do actually think there is 2 units of account technically. And I'm more of like a view, I guess it was A3 prime, because I think there was there's a debate in, I think, A3 around differences between retained MSRs and acquired MSRs, which I get, right? Normally when you have a internally generated intangible, we don't have a day one carrying amount associated with that. However, I do think that when we do have other situations where an internally developed intangible is part of a bundled situation where we're looking at fair value, like sale of a business, sale of a group of assets, we do take into account the fair value of that internally generated intangible into the value. So I still believe it's 2 units of account. And why I think that's important is when we get to the later issues, which I think was included in the paper around day 2 accounting, it might become important to think about it that way. Because at some point you're getting cash flows from 2 separate counterparties here. One, the counterparty to the servicing contract. And at some point when you actually do the recapture, you're getting cash flows from a completely different counterparty. And I struggle with how we're continuing to treat those as one when they're truly separated at some later date.
Brandon?
I don't conceptually disagree. Tom, what do you think about, because I gave this a lot of thought when I read this as well, of, I think considered cash flows, right? And when we talk about amortization, maybe that'll come up again, is the cash flows confined within this contract, or are we taking into account cash flows beyond this contract? And the only way I can square that, or trying to, interested in everyone's reaction, is that I think it's still confined within the contract. other than maybe broader customer intangibles I just mentioned a second ago. But if just thinking about the recaptures, I would think of the fact that you just recaptured is that's like a lump sum or a one-time payment, final payment as the customer, as the actual contract expires. I.e., yes, that final payment is actually, the ability now to realize cash flows in the future, but they're just, delivering back into you the continued right. But it's not the same contract. It's actually now a different contract. You have a loan that's going to turn into an MSR that may or may not be with the same counterparty. And so I view that as the final payment on the existing MSR right. And I think you have subsequent accounting questions of, well, does that get recapitalized somewhere? But I do think we could confine it within that particular relationship.
I don't disagree. In other words, when a recapture event occurs, you technically have now something that had value a day before the recapture event, which is now giving a right to cash flows in the future associated with the loan, or if you go and resecuritize it. So I agree with that, Brandon, but I'm not sure I'm following looking at the cash flows within the contract. I guess what I was just saying is I've realized this right, this receivable, and so that should be taken into account in thinking about the change in fair value. Otherwise, you're just going to write it off when you recapture, and I don't think that's consistent with the underlying economics, right? If you bought, the example is if you buy a retained, if you buy an existing MSR in the marketplace today and you pay $5 for it, and there's $1 of recapture because there's a high likelihood that one loan is going to refinance tomorrow, and tomorrow you actually refinance it, that model would write that dollar off when you knew it was going to happen. And I actually think it should roll into the carrying basis of the loan that you just originated.
Yeah, I think that is what I'm implying.
Okay,
Is that
yeah.
like
So you're not
the
aligned.
final payment is the dollar
Agreed.
value now that's coming in, and there's a subsequent, where does that dollar go?
Right.
Does it get recapitalized somewhere?
Right.
But
and
I'm thinking of the MSR itself and the life of it, and that's the amortization comment. Like I do feel like that last dollar it's a non-cash payment
right.
of something.
Exactly. And the reason why I think it's got some attractiveness to it is I think it'll solve the issue of future intangible value, right? I think some of what I've read, and particularly in the non-banks, is they want to continue to have ancillary sources of income from that customer relationship, right? And so I think we can come up with a model in which you could deal with that depending upon what the nature is of the recapture, right? If you're selling insurance products, if you're, originating loans and not reselling them. I know today most of them are just rolling it through future securitizations, and so maybe it's not an issue because the dollar in my case, it would just turn right around and get captured in the gain on sale, if you will. But that's why I think about it differently.
One more. Sorry for dominating the Angie. You'll probably clarify Tom and I's discussion here really quickly. I just had a question. When you said A3 prime, was that to get retained MSRs or originated retained MSRs on the same basis as purchased MSRs? Because that's my main concern with A3 and the consistency, I think, questions that Angie and Ashley were talking about. Is A3 kind of bothers me is that if you have MSRs on a balance sheet, they have different values of how they got there. Was A3 prime to get every MSR on the same basis, whether retained or acquired?
Yes, it could get you there. I'm also not opposed if the committee thought that this was optional to include the two pieces together at fair value, right? Or not. So separately account for a customer relationship intangible and separately account for an MSR, or combine them from a fair value perspective. I wouldn't be opposed to that too if people thought that would have merit and users would see value in it.
But just to clarify, alternative A3 prime would mean we are recognizing a otherwise internally developed intangible asset for
Yes,
retained
because of the
MSR.
fair value model. Yeah.
Yep, just to make sure we're all on
Yep.
the same page on that. Yep. Angie.
I think out of the gate, and especially as we were talking about this internally, maybe before I read the issue summary, I was pretty solidly A1. I like the simplicity. I like the consistency. I like maximizing observable inputs. Like that all has a lot of appeal. But I guess as I was reading through, I was a little bit swayed to Tom's point on the fact that conceptually A2 feels the best, but I felt like A3 did a really elegant job of maybe being more conceptually pure to separate the assets, but maybe didn't upset the apple cart so much, right? So if we look at retained MSRs, if we look at the agency guidance relative to what the regulators say, A3 might give you, and I'm going to set aside as Brandon's point, which was a really good one about banks acquiring MSRs. I appreciate that that's a tension point on A3. But A3 is pretty elegant because if you've got non-banks, primarily acquirers, doing fair value on the total assets, but separated into two, and you've got originators staying without recapture, it feels a little bit like all is right with the world, and we're not running afoul of the agency guidance for the banks. Our banks and originators are the ones that have loan commitments, so we're not running into double count, presumably, because they won't have them on the balance sheet. So there is some elegance to the implications of going to A3, but I haven't completely solved the issue that Tom and Brandon were bringing up of how disruptive it might be to have two pools of MSRs on the bank level. And the other thing I would just mention is, and as we'll get into amortization and double counting and what day two and all that good stuff, I think it's really important, no matter what, whether we define recapture or we don't, is to be really crisp on what the asset is. I feel like that keeps getting lost. We keep talking about, well, you're double counting cash flows and it's all in the cash flows and it's in the prepayment speed. But the asset is the right. It is the right to potentially get an MSR in the future. So I think being really, really crisp about what we're talking about might alleviate some of the other concerns, like when we get into amortization period list. Should it be longer? Does it need to change? Well, if it's the right and the asset is the right is only your right through the existing life of the current MSR. So I think that conceptual discussion of what we're actually valuing is super important to all of these questions. And that's a piece I feel like we talk about changing this input or changing that input or which input and should we define it. But being really crisp on that, I think will help answer some of these other questions.
Thank you, Angie. Michael?
The only thing we wanted to clarify is that the non-banks are also, they acquire more, but they are also originating and retaining MSRs too. So they're not just acquiring
Got it.
MSRs, so they will have
Fair.
both types.
Fair.
Dan, do you want to respond to that?
Yeah, and I'm happy with other inputs as well. But the way I read the guidance, the banking regulator guidance from back in 2003 was a bit more focused on, can you support and defend recapture? Does it exist? Is it real? Can you come up with reasonable estimates for it? Can you support it? And that was more the focus, and certainly anchoring back and defaulting to GAAP. Does GAAP permit you to include recapture in the measurement of an MSR? But to me, when I read the guidance, that's what the focus was. I'm strongly attracted to alternative A1, really looking at the market transactions, and the fair value does include recapture. And so when we're initially measuring an MSR through the sale of a loan and retaining that right, and we have to estimate fair value. It seems crystal clear to me that fair value includes recapture. I think whenever you sell a mortgage servicing right, recapture can't be separated from it. It travels with it. And the paper also observes that today, when we're valuing a mortgage servicing right, we include float in there, and float is not between the servicer and the investor. So we already have a component of fair value that is not just between, those two parties. So adding additional element here where there could be value, between the servicer and the borrower is not overly troubling to me. And I just think the additional complexity that will bring on for a number of different entities that both have retained MSRs and acquired MSRs, if we have two different models, that I think that could be a bit challenging.
Thank you, Dan. Brandon?
Well, Dan did a really eloquent job there on, some of my perspective. I have a slightly different perspective on, I think float's a little different, but I appreciate the point. The other thing I would just say is, and the paper talks a little bit about this, and I think is the FASB staff did outreach with the valuation folks. You've probably heard this, which is whether a company asks them to exclude recapture or not, they might be giving the company that's asking the same value. And you say, well, how is that possible? And I think it's kind of what Dan just said about the agency guidance. And yes, it says safe and sound practices, but it does say you must support it, which I always found like an interesting aspect of that. And I think the reason they're getting similar values is that this is a level 3 asset that any valuation person is trying to benchmark back to broker quotes and transactions. And if transactions and broker quotes include a fair amount of market participants thinking about what can I recapture, how much value can I realize, it's all gravitating to the same value. And so we might, when we're thinking about a pure A3 approach of not allowing it for retained MSRs, maybe overstating the case, but that's an entirely different value than if you quote explicitly include recapture. And that's why I kind of always just get back to A1 when I think about the best response, because it eliminates that nuance of trying to tell someone that they need to exclude it or not include it in a market that is inherently including it one way or the other. I have similar views when we get to disclosure later, when I read that you have to disclose what the value of recapture is. And it's like, well, if you're implicitly doing it just through the market transactions, I'm not sure what that number is anyway.
Dan?
And I think, Michael Ashley, correct me if I'm wrong, but I think we're hearing from some of the outreach as well for some institutions that originate loans, sell the loans, retain the MSR, and ultimately when they sell that, and if they're not including recapture in their initial measurement of the MSR, when they do sell it, oftentimes there'll be gains that they have. And it's really some of the feedback we're hearing, it's because they did not include recapture in the initial measurement.
Paul?
I agree with everything that Dan said. Maybe some incremental points. I don't take a lot of stock in the agency guidance because they have a different objective, and their safety and soundness, and we're about disclosures to investors. And so if whatever the bank regulators are going to do, they're going to do. I don't think personally as an EITF member, I should be spending a lot of time worrying about that. I just want to reiterate, I think if we stare at any executory contract, we can start breaking up an executory contract into 1,000 things. I don't know that that helps the transparency. I think if we leave it at one unit of account, investors are going to better understand that. And I'm very sympathetic to the point that Brandon's talking about, is that people are gravitating to the same number generally, and they're doing things by playing around with other inputs. And so the staff highlighted that, if they didn't explicitly recapture, in situations where they expect prepaids to be going up, they'll adjust the prepaids down to fit back to a number. I'd rather just give the investors a better vision of, this is what we really think prepaids are, this is what we really think recapture is. And so I think I leave that at one unit of account, and then we'll get to the how some of the other questions. So
just on it, and maybe we're dancing on the head of a pin, but I think we have to answer the day 2 question to decide whether it's one unit of account or 2 unit of accounts that are combined and fair valued. Because I'll be honest with you, I struggle with one unit of account and writing off the retained value, the recapture value when all of that recapture occurs, sort of the point Brandon and I were talking about. So
Right.
I don't know if there's a difference in calling it A1 versus A3 prime, but I do think we have to talk about the day two issue at some point.
I mean, we're not going to solve this. The real issue is why are we fair valuing executory contract? Because as Brandon pointed out, this is the only place we do it, but
Yeah.
okay.
Well, yeah, and I have a theory around that, but that's hedging.
So we could start a hedging project instead.
But Tom, I do think even your alternative A3, you said it would be optional to recombine together.
Well, that
Right,
I
so
think we
there
could
is a
debate.
distinction
We could
there.
debate whether there's an option, but
Yeah.
I think the first question is whether you view it as one unit of account or two unit of accounts. Do you believe that someone should be at least allowed to fair value the combined unit of account or the one unit of account? It seems like there's support for that. Without answering the second question, whether you want to make that required or optional, maybe that's a separate question.
I think the question would also be, I mean, whether it should be allowed, but whether anyone should be permitted to have it as 2 units of account, I think is a valid question for
Yes.
the EITF to think about.
I do agree that the subsequent accounting question, I guess I viewed that whether we're A1 or A3 prime, which I think we've defined now, I would think we can answer the subsequent accounting question and still get a capitalization of that recapture under A1 or A3 prime, and whether we have to answer that or whether in practice we do. And I think it's a question of materiality. Like, are you, if you're originating loans held for investment that doesn't get realized through a gain on sale, like, do you allow it to just disappear? How material is that? But I guess I'm interested in like whether we that subsequent accounting question, I just viewed that we could answer with A1 itself and still get to that same conclusion. And maybe this doesn't matter, but when I hear 2 units of account, I feel like we're now allowing fair value of an intangible. So like we're already allowing fair value of an executory contract, and now we're saying, well, there's a second unit of account. We can combine it for financial reporting purposes, but that's not just balance sheet presentation. We're allowing the election of a fair value option on that second unit of account. And maybe I don't need to conceptually like turn myself in circles too much on that, but it just feels odd.
Yeah, no,
We're now
agreed. But
saying
it's
we're
but
fair
it's but it's like
valuing.
legally attached into the contract. I guess that's the difference, right? And so it's sort of like which one carries the most weight in deciding what the measurement model should be. But I get it.
I mean, we spend more time trying to put contracts together as opposed to tearing them apart. I mean, in a lot of other places in GAAP, we sit there and go, hey, these contracts were entered into at a similar time. Let's put them together because and now we're saying this is one of the few examples where we're going to make it strip the contract apart. That's where just, I don't know.
There's a lot of cases where we're stripping apart. In fact, this is being part of stripping things apart, right? And we have embedded derivatives. We strip things apart. We have all sorts of contracts. We have separate accounting units. So listen, to me, whether we call it A1 or we call it A3 prime, I don't think it matters. I think addressing the day 2 issue to have something that is a sustainable model as, the next round of intangible value gets captured in these things, which I would imagine with technology and ability to cross-sell and all of that, I would imagine that's going to be the next generation that's going to come into value. And maybe that's not in there today because it's mostly assuming you're just going to do another securitization and get another mortgage servicing right. And so maybe the day 2 issue is not even big today, but that's my observation.
Dan?
Is the key day 2 issue we're focused on here is that when the single loan is going to prepay, in essence, we write off the recapture value at that instant, and then Yep, exactly. And then it might be the excellent example that the staff has in the back of the paper. You have to wait till the new loan is funded and then sold, and you retain that MSR from the new loan, and it has the MSR value there may also have some recapture in it. That's when you would, in essence, restore some of what you've written off. Is it kind of that time period where we're writing it off and then restoring it a bit later?
I think in that example it is. So the way I'd like to simply do it is, let's just assume you don't resell the loan, Dan.
Okay.
And you're just funding a brand new loan, right? There's no loan commitment or what have you. So, Dan calls me today, and I knew that I had a chance of refinancing with him. In the day before, in my MSR, there was $1 of value that was embedded there associated with Dan's loan, right? Which I recognize figuring that out is not easy, right? It's very complex, right? Tomorrow I make the loan. What do I do with that $1? If you just follow a classic view A, it's all one unit of account, you would write that off because no one would pay for it in the marketplace. But it seems like you just paid $1 to originate a loan. You follow me?
Yep, I do.
And so that's my concern. Like, I don't think it's probably a big deal today because people turn these things pretty quickly.
Right.
So I don't think it's like a big, heavy lift today.
Yeah.
But if you want to have a sustainable model that can deal with any customer relationship intangible, I think at least acknowledging that maybe there's some accounting you need to think about in that scenario. So maybe the $1 would be part of the basis of the loan and come out over time, right? Does that make sense?
Yeah, yeah. So what would you do, I guess, with that $1 in that instance? So as opposed to writing it off, would it be part of the basis of the new loan that gets originated?
Right.
So it might be, if it's funded at 100, there might be 101.
Exactly.
Got it.
Exactly.
Okay.
Yeah. Because I'm worried about situations in which there's massive recapture events.
Yeah.
And people writing off MSRs and recording losses only to get gains in the future. Right.
And it would only be, I think that your point is loans held for investment, because if it's a loan held for sale, it would actually be in the loan commitment value and then in the loan value. And like, even if you capitalized it, it would immediately reset back to the fair value of the loan, which takes into account the new MSR. I think from a technical perspective, those other customer intangibles, the ones that don't have a lot of value now, supposedly, and might in the future, I don't know how you ever deal with that, because those are actually not even part of that next loan. Those are some,
well, that's what I'm saying. It could be a
yeah.
customer acquisition for an insurance contract,
Yeah,
or it could be, that's what I'm saying. But acknowledging it, it's almost as if you bought you bought it the day before, and now it's going to be a separate unit of account again, if you follow me.
Yeah.
And I know I might be in the weeds on this, but thank you.
Matt?
Yeah, I mean, I really appreciate the conversation. I mean, I think I understand all the different points, and I'm kind of personally battling between, I would say, like the conceptual and then the practical, right? And the fact that it's really hard to unpack the value for some. It's just included in the number, that type of stuff. And then I guess the item that Brandon kind of pointed out that I wanted to make sure is, a lot of, we're forgetting the commitment in there, right? The rate lock commitment that is a, kind of would also have a value of that I'm going to make the loan and I'm going to sell the loan. And, so if you had noise of writing off the MSR, the minute you're doing that, you have a rate lock commitment before you write off that, and there's a gain there. And so, yes, there's noise there. You could roll it in maybe some way, but like in all actuality, they kind of overlap a little bit. And so, I'm somewhat gravitate more to the one unit of account. A lot of people are doing it today. I think it's something that a lot of the valuation providers can handle. I think it's, is it the most conceptually pure? Probably not. Yes, it has some, difficulties, and I think there's some, things to think about, but, that's probably where I'm at, thinking about it on balance. But again, if there's other more eloquent ways to do this that I think are easy for investors to understand, valuation providers to do, auditors to audit, companies to prepare, I'm all ears. But right now, part of me is, kind of just very simply, this is what people are doing right now, and doesn't make a wholesale change starting to make new units of account and all kinds of other different types of things if, we just focus on cleaning up the issue a little bit of saying, okay, well, it's unclear if you can or can't include it. And so that's probably, a little bit of how I've focused on it, but understanding that I think a lot of these are really good points, and I think there's definitely a rabbit hole we can dive on this. So.
Thank you, Matt. Angie?
Yeah, I think I'd just point out, again, I think what I said earlier, have been attracted to A1, so I sort of like it. And I'm less, but I, again, conceptually, A3, A2 feel a little bit better from the accountant in me. But I guess to Matt's point, what people are doing today, I am really sensitive to that too, because we do have a population of folks that are not fair valuing it. And fair valuing it with recapture. And maybe that wouldn't be a huge practice issue for the banks. But I think if we go A1, like that's a very pointed question we need to ask, because I think we're assuming that an A1 answer is the easiest thing to do for practice, because that's what folks are doing today. And that was the agenda request. So I appreciate that A1 feels like the maybe path of least resistance, but I think there could be some additional commentary on how hard that's going to be to apply. And then the other thing I just wanted to mention on Tom's point, which is a great one, right, is this day 2 accounting. But I guess I think defining what we're valuing is incredibly important, because I'm not that bothered if there's a recapture event and that right no longer exists. And so that goes away. And if you get a whole loan out of it and you put an asset on your books, so be it. If you get a loan and you sell it and you get an MSR, that's great. I guess I'm not all that bothered by that point in time where you are the fair value of the right is going down, but you're not realizing the benefit of the asset that you got back later from someone else. I'm kind of okay with that. So just personally, I probably have less consternation about that noise.
Thank you.
I guess where I struggle is if you're really good at recapturing, right? And you can actually better than the market, you're going to be recording more losses. So I don't see how that lines up with the economics at all.
Yeah, but I think you do have an asset coming on your books.
Yeah, the question is, did you pay a portion of the MSR value for that asset?
Yeah, I'm with you.
David?
I mean, that's the part that I don't get on that. I think I'm kind of more where Angie is on that, but like when Tom said it looks like you paid $1 for that new loan, well, what is the converse, that you paid nothing for that loan? I don't know, that part kind of confused me, where in theory, if you allocate $1 to that recapture right, you did pay $1 for that recapture right, you got the recapture. And that's, if I'm looking at, do I have an asset anymore? I'm confused why we do. I know we have similar, things that are capitalized on balance sheets that are assets that are amortized over time. I personally, a whole nother thing, but like, that's the part I don't like. If I were looking at the economics of it, the $1 I spent is gone and I got what I wanted out of it. And I understand that you have a loss, but that loss, and this is the part that's out of my depth, is this isn't like quite the margin type thing I'm used to dealing with normal corporates, but they better recoup that loss in whatever comes on, right? Mm-hmm. And that's the analysis. And that's where, is that not right? Like,
I'll try to help Tom out here in answering that, because I don't think you have another asset. I think you have an asset. The asset's the loan that you just realized. I think Tom's talking about what is the cost basis for the loan. What did you pay? So you paid $100. You funded $100. You actually gave them $100 in proceeds. But did you pay 101? Because you basically reclassed that $1 asset, the one that Tom is saying is actually a second unit of account that we're allowing it to be combined. And so should you really, credit the MSR and record a loss, or should you credit the MSR and record another $1 into the cost basis of the loan? And conceptually, I agree with Tom. I think it's a $101 loan. Today, most of those loans go right back into held for sale and get marked to market. So for those, I think all of it, you get some geography issues, but an MSR has got all kinds of geography issues anyway, because there's runoff that's being decomposed all over the income statement. But as long as it goes into a held for sale loan and it's kind of in the mark to market and the overall gain on sale, I don't think it's a big issue. I think it's a big issue. Right now, I don't think it's a material issue because I don't think a lot of companies put loans back into held for investment in a recapture event. But if they did, do we need to call out that think about this? Think about, should that be 101? I think I lean towards what Angie said is, I think conceptually Tom's right. I'm not sure we need to answer it. And maybe it's just an acknowledgement that it exists and that if a company does have material recapitalizations of loans held for investment, you should think about this runoff in a way that you make sure you're not just writing it off to the P&L when the asset really, you paid for it. It should go somewhere.
Yeah. And maybe just to clarify that. So I agree. I don't think this is a big issue today, but I'm worried about having to try to define what recapture is and try to address the next intangible value, customer relationship value. So that's why in the way I've been thinking about it is if we can acknowledge that there is a customer relationship intangible that's inherent in these contracts, right? And we see that you've got contractual rights to do that and that we're allowing for accounting purposes for you to include it in the overall fair value of the MSR, that's great. But if we just acknowledge that there might be a point where that customer relationship intangible has now come out of the contract, right? And it might require separate accounting and just acknowledge that. Today, I don't think it's going to really adjust practice for those that are doing recapture because as Brandon said, they're churning it, right? And so I can't imagine it would ever be material, right? But at least it's something that I think we can frame it back to existing models, right? And it would allow flexibility in the future for, as these things evolve, people to deal with the day two accounting.
Understood. You're looking for the flexibility for
Exactly.
the two to be, say there are two, they could be combined today, they could be separated in the future.
Right.
Understand the other viewpoints of maybe there's less comfort of having any ability to have a separate intangible asset in a retained MSR, right? That's fair valued, right? Understand different views among the EITF members with regards to that. Looking around the room and on the screen to see if we have any other viewpoints, perspectives, questions with regards to the unit of account question that we've been discussing. All right. If not, what I think would make sense is to go around. We've gotten some initial leanings from folks, but this has been a great discussion to kind of go around the room and see where we are with regards to paths forward for a recommendation for the board. Now, I think, the question about I think let's just go with one or two units of account for now, and then we can kind of come back to, actually, give me your one or two unit of account view on alternative 1, A1, A2, A3, A3 prime. And it would be helpful to understand if you think that the EITF should also address day two issues that we've been talking about. So I'm just going to start in the room going around and then we'll go to the screen. So I'll start with Angie.
I knew you were going to start with me because I was the most ambiguous in my remarks. I'm going to go A1. And as it relates to the day two issues, we'd obviously need to deal with the next issue on amortization, but I would say we don't address. I think we go full boat fair value, and a full boat fair value day two is something less, so be it.
Okay. Great. Thank you, Angie. Todd?
I agree with that. I guess I'm not persuaded that the churning issue is that material if you have large recaptures, but I think I see Tom's point on the conceptual issue. It doesn't really make a lot of sense, but it seems like maybe in terms of practicality, A1 seems like a right fit for me.
Thank you, Todd. Matt?
I am A1 as well. So,
And thoughts on second or on the day two?
I think I'm aligned with Angie as well. So,
Yep. All right. Paul?
I'd like to introduce A4. No, I'm just kidding. Sorry, Dan. I didn't mean to do that to you. I'm a, I had to. I'm A1 and I would just do full fair value.
Thank you, Paul. Dan?
Also, A1, and yeah, right now I'm not concerned about the day two accounting. I think we were not hearing that as a concern from a feedback perspective, but we, certainly could ask a question on that, from constituents
Right.
as well.
Yep, absolutely. Great point, Dan. Brandon?
I'm A1. I would suggest dealing with subsequent accounting if we could somehow in the basis for conclusion, that it was discussed and acknowledged that if something became material and not in the churn, that you'd have to think about it. I don't know if that's possible. And I would just reiterate that I think question 2 of SAB 109 cannot coexist with A1. And we have to think about dealing with that.
Thank you, Brandon. Jeremy?
Yeah, I've been very interested in Tom's perspective the past few meetings about this being a customer intangible, and I agree with that conceptually. But what I keep coming back to is that this is a tradable asset, and the simplicity of it and the comparability of it to try and break it apart. And I understand the day two issue, but if we're going to have a contract that is tradable and has a fair value in the market, I don't really see the purpose in all the hurdles needed to try and break it apart. So I'm on A1.
Okay, thank you, Jeremy. David?
I do find it challenging. I think similar with Tom on the day two stuff, it does affect the A3, but I mean, in discussions, I had a few discussions with analysts that cover a lot of these MSR type companies, and their primary concern was first consistency. And then, there's like a cherry of having the separation of this asset. If that were possible, that always helps to have a little disaggregation, especially if something with a different kind of counterparty and the fair value. But even they questioned whether that was going to be worth the squeeze to get it to be separated. So I think for simplicity purposes, and Jeremy, I think put it really well, but I would go with A1.
Okay, thank you. Tom?
I'm A4. Since Paul brought it up, I think you know where I am, A3 prime. I do think if we do mention something about the day two, Brandon, I actually think you could do in a way where it wouldn't violate SAB 109, because whatever this separate thing is, could still be sitting on your balance sheet and you could avoid the mark in SAB 109. So it would also, I think, neatly get resolved through that method. But you've heard my arguments about the economics. I'm just concerned about those that are the greatest in recapture actually recording losses when they have the great recapture events occurring. Seems to actually go against the economics.
Understood. Thank you, Tom. Kate?
I actually like A3 more, I think, because I do think there are potentially two separate things, and Tom's point about the losses resonates with me. But I probably ultimately would come out at A1 just from a simplicity perspective, but I do think Tom's point around the loss piece kind of plays in my head a little bit in A1.
Yep. Appreciate that. Thank you, Kate. All right, so it does look like we have a majority that are a path or alternative A1. So with that we're going to use that for purposes of going through the next, the rest of the questions, right? For those that were specific to A2 or A3, we will be excluding those questions as we kind of go through. So I think that takes us to issue B, which is whether to define recapture. And I know we've had some discussions already with regards to, what is recapture and how specific do we want to be with regards to, do we want to define it? And if so, what do we want to include within that? So I want to open it up to the EITF members to see if there's additional feedback with regards to whether to define recapture before we talk about the two alternatives, which are either define it, and then we'll come back to the next question of what should be included within there, or alternative B2 of not defining recapture. So I'll open it up to the EITF members for discussion. Brandon?
I just have a quick comment on it. I think if if we feel strongly that you should exclude other value besides recapture, it feels like you have to define it. And if we think it's just all one unit of account and the valuation and the market and there's transactions, then I don't know why we would define recapture.
I think that's fair, Brandon. Angie?
Yeah, I'd agree with Brandon. I'm in the full fair value camp. So if that's where we are in A1, that we're looking at observable inputs, full fair value, 820, then I don't think we need to define it. I think if we feel like we need to say, like, for example, the fair value might include recapture, I could probably get behind that just in terms of trying to trace back to why we were ever talking about this. I think that might be useful. But I think if you're, to Brandon's point, if the idea is that we're going full fair 820 fair value, then I don't think it's useful. Probably creates more problems to define it.
Thank you, Angie. Tom?
Yeah, I don't think necessarily you have to define recapture. I would make a comment around a customer relationship intangible that's sort of inherent in the contract, something vague like that, because I worry about people attaching all sorts of other cash flow rights to contracts and trying to say it's part of MSRs, right? Which I know that doesn't happen today, but as we know, people are very smart. And so I'd just be worried about that. So I don't think I would just move to a, yeah, you could put whatever you want in the contract and it's part of the MSR, because I think that's a slippery slope.
Understood. Matt?
So I'm fine with examples. I'm fine with other mentions. I ground back to, fair value 820 market participant assumptions and say, okay, what are you going to get for it? What's a market participant use? What's the, those types of items. And I mean, if there are evolutions and what you're getting paid for and what you're going to be able to realize, so be it. But I think it's really hard to guess what all of those are going to be. Right, because I think different market participants may bid different things for different reasons or be better at one thing than another and willing to pay something for that or not. And so I get a little concerned about whack-a-mole and trying to define each one of those items, each time they come up versus just grounding on what I think is just, what is the fair value and what would a market participant think about and include in there.
Thank you, Matt. Other comments or perspectives, questions from EITF members? Looking around the room. No, I think out of everyone who's spoken so far, so Angie, Matt, Brandon, and Tom, I believe you're in the B2 bucket, correct? Alternative B2, but I think there's some questions of what could we put in from an example perspective to help further describe the discussion we're having and why we're having this discussion today, which I think is a fair point. So if there are no other questions, I will just go around to the members I haven't heard from yet, just to make sure I can get votes. So start with Todd.
Yeah, I agree with Angie and Matt.
Okay, me too. All right, Paul. All right, Jeremy.
B2.
David.
Yeah, I mean, I agree about the abuse and all that type of thing. There are other considerations, but I would think all that exists today, and it doesn't. We're not going to talk. I think Matt said it well. We're not going to get all those issues anyway. But.
Okay, perfect. Dan.
B2.
Okay, and Kate.
Agree, B2.
All right, so it looks like we have everyone is in the same page on a B2 perspective. So that would take us then, we don't have to talk about question 3, right? So we'll move on to issue C, which is the issue scope. So this is, which alternative does the EITF support? Do we want this guidance to be specific to residential MSRs, or does the EITF want this to be more broad and would apply to all servicing assets? So with that, want to open it up to the EITF for discussion, questions, comments with regards to the scope of the application of this guidance. See if there's any thoughts or perspectives. Brandon, thank you.
Also, just a quick comment. I mean, I haven't thought about it enough to expand it, I guess is my, part of me says, well, why wouldn't it apply? But I'm also a little concerned that we're going to have some servicing right asset out there where there's a lot of value in customer intangibles. but it makes me go, well, why am I A1 for MSR if I'm not okay with that? But I just think it's easier to keep it at MSR. I mean, is some company going to write in 6 months and say, well, you've excluded me and now we're talking about some other servicing right? I don't think that's a huge concern, but I think it's just easier to keep the scope narrow.
Thank you, Brandon. Angie?
I just say ditto to
Great.
Brandon.
That works. Jeremy?
Have we heard any in our outreach discussion or questions about other servicing assets, or why would we not do it for commercial loans, et cetera?
So we talked to some valuation specialists who value commercial servicing assets, and they said it's just not a material item right now, just because they're either variable rate loans, so they're not as sensitive to interest rate risk for the recapture event, or there's significant prepayment penalty, so there's not a significant value there. So it's just it doesn't seem to be an issue currently with those asset classes.
I just don't know how we can lay down a sweeping change like this when we've spent all this time discussing a particular type of asset. I'd just keep the scope narrow and keep it with residential MSRs.
Okay, thank you, Jeremy. Appreciate that. Other comments, questions from the EITF?
I mean, I guess it's not material now, but did you get any outreach that if we were to change something this, it might, the market might change?
There was not, I think
much.
it's hard to speculate. I think there was nothing to indicate that it is currently the same value, but there was no ability for them to speculate. They based on the terms, they don't think so, but it's still it'd be more speculating anything.
All right. Then with that, I will ask for perspectives from members that we haven't heard from already with regards to this question. So again, alternative C1 would be limited to residential MSRs, and alternative C2 would be for all servicing assets. I'll start with you, Tom.
I could go either way. I mean, if we sort of observed or commented on the day 2 comment, I'm not sure why we should limit it, because it seems like we'd have a workable model that could be applied in all cases when you've got some embedded customer relationship and tangible value. So I'm not opposed to that, but I'm also not opposed that if the board or the EITF wants to limit it, since that's the scope of the issue today, I'm fine with that as well.
Okay, great. Thank you. David?
I mean, all servicing assets just sounds like a very big scope for me that I am not comfortable answering that question, I would say. So keep it at the scope level that we've discussed here for EITF purposes.
Okay, thank you. Jeremy, I have you on C1. Brandon, I have you on C1. Dan?
C1 as well.
Okay, great. Paul?
So maybe just a clarification. If we say C1 and there is a significant, the market changes, are we going to try to tell people that because right now there's diversity in practice, and because people are reading the guidance differently. And so say the market changes, say it goes to credit cards. I don't know, I'm just making this up, but say it does. Is diversity in practice going to exist? Because right now you can read the guidance either way. And someone could say, well, the guidance isn't clear, so I'm just going to analogize to what's in the residential MSR. So I was more where, well, I thought I was where Tom was going, but maybe I'm not. I'm fine either way, because I think in reality, when we answer this question for residential, when the market changes, people are going to have something to point to. And if we don't want to explicitly say that, that's fine. But I actually know what's going to happen in practice. We're not going to object because people are going to say, well, it's an analogy, the market changed, and this was good thinking. So I'm happy writing down residential. The reality is that the market changes, we'll probably get to a similar spot, but it's fine.
And Paul, I think that's a fair point, right? Typically, analogies are permitted unless they're prohibited, explicitly prohibited. And I
Right.
don't think what I'm hearing here is that there'd be any reason to put in specifically prohibited analogy, right? But we
Yep.
may not need to say analogies are, absolutely included. But I think that's
Right.
generally how things are looked at. So
So that was a long way of saying C1, but
perfect. You got it. All right. Matt?
I'm C1 as well. I mean, I think we can ask questions in when this goes out, just to see what people think. And if there's any other items, I think no prohibition would be great. I think that just to make sure we're not back here in a couple of years, tweaking this again. So, but yeah, C1.
Okay, great. Todd?
Yeah, likewise.
Okay, perfect. And Kate?
C1.
Okay, great. All right, then amortization, so issue D. So here we have existing amortization guidance. I know we've had a little bit of discussion already among the group with regards to whether or not there's a need to amend the existing amortization guidance. So do want to open it up, but we have, which alternative does the EITF support? D1 would be not amending the current amortization guidance. And alternative D2 would be amending the amortization guidance to require an entity to include estimated future net servicing income from refinanced loans. So I'd like to open it up to the group for discussion with regards to issue D. Paul? Oh,
Sure. I was in D1. I don't think we need to amend. They're different measurement guidance. I don't think we need to reevaluate. So
thank you, Paul. Do others have questions, or Brandon?
I agree. I'm D1. I would just observe that I think for recapture itself, I don't think it's a contradiction. I still think the value is being realized within that service contract period because it goes away, it gets, recaptured, but it's not like that value continues on. The recapture value doesn't continue on. The customer intangible value, that separate unit of account Tom keeps pointing out, that does continue on, but I would still not try to reconcile that and go with D1.
Thank you, Brandon. Angie?
Yeah, I agree with Brandon. We talked about this a little bit ago, that the recapture right that we're talking about is the right, and the right only benefits you over the period of the existing MSR. So I don't view it as a contradiction either by just letting the amortization guidance exist. I do think there are some complications depending on how it's modeled within the valuation. So you could have situations where folks model it in the prepayment speed, where you could get some odd answers, and you might be left with something at the end. You might be backing yourself into an impairment, but I think that's because you haven't sharpened your pencil enough on how to value it and account for it, and you're not recognizing the fact that you're valuing the right, not the replacement MSR. So again, I think the concerns about backing yourself into impairment, or you're too slow to take that write down of the change in fair value, I think that could happen, but I think that's because perhaps you're not being intellectually pure with how you're doing the valuation and the subsequent accounting. But the amortization guidance itself, I don't see needs to be changed because I don't see a contradiction.
Great. Thank you, Angie. Not seeing other comments or questions. So if it's all right, I'll go around for those that we haven't heard from already. Tom, I'll start with you again.
I don't think we need to change. So I'm I guess,
D1.
D1.
Yep.
D1? Yeah, D1. That being said, the application might be slightly different depending upon how you're thinking about recapture.
Yep.
And so whether we'd want to acknowledge that or not, I don't know, but I don't think we need to actually change the little words.
Okay. Thank you. David?
I'm okay with D1.
Okay. Jeremy?
D1.
All right. Brandon, we already have you as D1. Dan?
D1.
Great. Paul, we have you as D1. Matt?
D1 as well.
Okay. Todd?
D1.
All right. And Kate?
D1.
Thank you, Kate. All right. So then we have moved to issue E, disclosures. So looking for feedback from the EITF with regards to whether or not you believe that new disclosure should be required. Your alternative E1 is do not require new disclosures. The existing disclosures would be sufficient. Alternative E2 would require an entity to disclose how it determined the value attributable to recapture. First, want to open it up if there's any questions, comments, or views that want to be shared by EITF members. Dan?
I think the paper does a really good job of highlighting, one of the opportunities we'll have here is to directly link when we say fair value for MSRs, to tie that into 820, and then the 820 disclosures will follow suit. And today, in practice, I think that it happens, but there's not an explicit link in the literature, which the paper does a good job drawing out. So for me, I think that's sufficient where we don't then need to come up with, additional specific disclosures that we would look for here. Paper does a very good job articulating where this is material, those elements should get covered. And I thought, the observation about how good an individual entity is at Recapture, where you focus, that's really kind of more of an MD&A type of item. That's not a market participant, that's entity specific, and there could be value in that, but folks should really look to, provide that information with an MD&A. That's obviously not our purview. So.
Thank you, Dan. And I think that's a great point. When, if you're E1, do not require new disclosures, that doesn't mean we can't be very crisp about what disclosures are applicable, right? And making sure that that's very clear as well. Any other comments or questions on disclosures? David?
I mean, I would think generally, and I'm always in the camp, if it's not going to be quantified, I'm okay without it. And if they're not going to quantify a total recapture, I don't know what I can do with that information. I can't test it. I can't stress it or do anything. It's just more pages in the financials.
So I take you as a E1. Perfect. All right. Any other comments, questions? All right, then I will go around. I'll switch to this side of the room again. Angie?
E1.
Okay, great. Todd?
Yeah, we usually ask for more disclosures, but this time, I think Dan put it well. It's a framework already, so E1.
Okay, perfect. Matt?
E1.
Okay. Paul?
E1.
Dan, we already have as E1. Brandon?
E1.
Okay. Jeremy?
E1.
And David's E1. Tom?
E1.
E1. And Kate?
E1.
Great. All right, so with that, we can move on to questions 8 and 9. I'm going to combine these two from a voting perspective. The recommendation is to have this guidance applicable to all entities, so no difference between public and non-public entities. And question 9 is whether or not the EITF agrees that this guidance should be required rather than optional for all entities. So would appreciate first any questions with regards to whether or not this should apply to all entities and whether it should be required or optional. Not seeing any hands, or so with that, I will go back around for voting. I'll start with Dan this time.
I would support doing it for all entities and having it be a requirement.
Okay. All right, Brandon.
Agree, all entities and requirement.
All right, Jeremy.
Same.
David.
Yeah, we're addressing kind of a consistency issue. So all entities required.
Great. Tom.
Yeah, I'd also support the recommendation. However, I'd probably encourage the board to ask that question to see if we uncover any differences or perspectives we haven't considered.
Okay, fair point. Thank you, Tom. Angie.
All and required.
Okay. Tom.
Same.
All right. Matt
All and required.
and Paul
Same.
and Kate.
The same.
Okay, great. So I think we are through and appreciate going through all of the different questions associated with this issue. And the last item that we have is more of a, does the EITF have feedback for the board, right? This is a recommendation that will come back to the board for consideration. As part of that, we will bring back a discussion related to transition and early adoption. The memo has a bit of a discussion of what the potential transition options could be, whether that's prospective, retrospective, or a modified retrospective approach. This is more of a question of, do you have any specific feedback you think would be helpful for the board's consideration when they think about transition? We're not necessarily looking for votes with regards to this. So this is more of an open call if there's any feedback for the board to consider from a transition perspective. And
I don't,
Brandon.
Oh,
sorry.
go ahead.
I don't know as much about this, but like in talking to it, it seemed like now is not a huge material issue currently. And depending on how long the horizon is, I'd be worried that you could adopt it more of an advantageous time. But if it was, lease accounting adoption, then that would be more problem. But if it's a shorter runway, then it's less of a concern.
Okay. Thank you, David. Brandon?
Yeah, I mean, my reaction was I definitely didn't think retrospective was necessary at all. Like a full perspective, like just seems to imply, if I read it right, like newly acquired or retained MSRs. That might be, I would assume companies might push back on not being able, like, to have two valuation approaches that they have to run forward, the MSRs before this conclusion, MSRs after this conclusion. So I think that meant I was more modified perspective, like allowing companies to cumulatively catch up, like on the date of adoption, so that they don't have to run two valuation techniques. I think what might be telling, if a bunch of companies say there's no cumulative impact,
Right.
that they have been including recapture one way or another, and when they go take it back out through broker quotes, but it's just an observation.
Exactly. I appreciate that. I think that's a fair, all of these will come back to the board for consideration, but I do think that's one of the items that have been considered by the staff with regards to current practice today, and depending on what alternative the EITF agreed with, that will impact potentially the discussion on transition. Matt?
I agree with Brandon. I just wanted to reiterate that I think getting to one valuation is probably the simplest. You want to just run it one consistent way. It's easier to do that versus multi. And then I think the other thing I would highlight is, again, we do have a lot of, banks and non-banks and interactions with regulatory reporting and, retro and refiling and all kinds of other different things going on there. So I tend to look more towards that prospective type approach versus going back retro, because either you have predecessor successor issues, you have needing to refile potentially, call reports or other different types of items like that. And so just things to think about when you think about the population of who this applies to, and the time to work through the system and which things are going to be applied. So, good things to ask questions on. So,
okay. Thank you very much, Matt. Very helpful. All right. I'm not seeing any other takers for additional feedback on transition or effective dates. So with that, I think we've made it through all of the questions related to MSRs and have a recommendation that will go to the board based on the decisions that were made here today. So we really appreciate all of the thoughtful discussion. I think this has been a really good discussion, a good ability that will provide a lot of basis for the board for thinking through their views on this issue, and thank the EITF with regards to that. This is the end of our public session, but before we actually close out our public session here, I do want to just take a few minutes just to thank a couple of folks. One, I want to sincerely thank Kevin McBride, who, for his service on the EITF. Kevin has taken on a new role at his organization and will no longer be with us on the EITF, but obviously we have all benefited from Kevin's engagement, his professionalism, and his collaboration during his time here on the EITF. So while he's not here today, we do want to just make sure that we have had the chance to say how much we have appreciated all of his time that he's invested to help improve financial reporting. So thanks to Kevin, and hopefully he sees this and we'll know that we've all really appreciated his time. I also want to thank Alana for all of her time. Alana has done just incredible work over the last year being the EITF coordinator, and it's just been a pleasure to work with you. We are very excited for your next steps in moving back to, Deloitte, and certainly we know all of the things and all of the benefits you've brought to the EITF will be a benefit to Deloitte. And we really look forward to seeing your future successes as well, Alana. So thank you again. You've been fantastic. And she's also doing a fantastic job of transitioning Edward into the role. So this should be very seamless for everyone here on the EITF. So with that, maybe I will turn it over to Alana for some closing announcements.
Thanks, Hillary. Based on the EITF recommendation, the FASB staff will prepare an agenda decision memo for the board to discuss at a public meeting. The agenda decision memo will include the materials discussed by the EITF, a summary of EITF discussions, the basis for the EITF's recommendation, and an analysis of the FASB's agenda criteria. The board will discuss the issue at a public board meeting and determine whether to add the project to the FASB technical agenda. As a reminder, our next regularly scheduled public EITF meeting will be Tuesday, June 23rd. With that, I want to thank everyone for your active participation today, and we are adjourned for the day for the public session. We'll see you at the next meeting.